Hello, everyone. We're going to give everyone a few moments to tuck in and get comfortable for this particular session. So I'm glad everyone is here and joining us today. This is going to be a fabulous session on getting money, what lenders and investors want. So I know there's a big interest in that. If you're in business, you're going to be interested in it. So welcome. I'm Linda Griffin. I'm the Education Programs Coordinator with Business Link. Thank you for joining us today. At Business Link, we are honored to provide services to all entrepreneurs and specialty services to our immigrant and Indigenous entrepreneurs. We are inclusive in our cultural understanding and awareness of the histories of our country. With that, we're going to start today's event with a land acknowledgement for the province of Alberta. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations group, Métis and Indigenous people, whose ancestors have walked this land since time immemorial, and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. Thanks for joining us today. A few housekeeping notes. This session is being recorded and will be posted to the Business Link site within 2 to 3 business days, so you'll be able to access the recording from there. I'm going to be placing a link to a series of handouts for today's sessions in the chat box. You will be able to download all the worksheets for this session along with the PDF copy of the PowerPoint in this session as well. If you'd like to ask a question, please shimmy on over to the Q&A box. So you've got 2 boxes at the bottom of your screen. One is Q&A for questions and answers. The other is chat. You are welcome to introduce yourself and your business and your type of business in chat and say hello. We're going to do the same and put links there. But if you have real burning questions, please use the chat. On that note, I'm going to welcome Vanessa Brown back. She's been doing the last 2 sessions, this session, and 1 more for us as we end this series. So thank you, Vanessa, for joining us today. And please take it away, and I'll do some chat inserting while you do.
Thank you so much, Linda, and thank you everyone who is here for attending. My name is Vanessa Brown. I'm a CPA. I have my origin designations are with both CMA and CA. I currently have 2 businesses, one of which is a professional practice where I do the corporate year ends and tax returns, and the other is something I call the Small Enterprise CFO Inc., and it is a business that helps business owners with their monthly financial reporting and getting an idea of their key performance indicators and a number of other things. It's more, that one is more in the business and not just reporting on the business and the taxes. So we have about an hour today, and you will get a copy of the presentation so that you can review it later. There's also a few other handouts. I will be referring to one of the handouts in the session. And this session, I just want to give acknowledgement. It is presented on behalf of the Chartered Professional Accountants of Canada, and CPA does stand for Chartered Professional Accountant. I didn't clarify that earlier. And accountants just generally help work with the numbers in a business and keep them honest and keep them successful. CPA Canada is one of the largest organizations in the world, and we represent more than 217,000 CPAs across Canada. As Linda mentioned, you can put some of your questions into the webinar chat. If you have them as you go, I will monitor it periodically as I discuss. One thing that would be helpful to me is if you feel led to do so, please tell me a little bit about your business and particularly what you are expecting to get out of this session. And I will do my best to incorporate any business-specific knowledge that would be helpful. So the session, Getting Money and What Lenders and Investors Want. We have lots of questions that business owners do ask in this area. These are some of the common ones. Why will I need additional financing and capital? And this gets to what is the clear intent. So we have a clear business intent, and we also have adequate financing for any contingencies, any surprises that come along in the business along the way. We want to talk about what are the typical sources of financing, and particularly for those different types, what are the advantages and disadvantages of each of them. We want to talk about how lenders and investors are different, because when you are getting money from other people, they can come in the form of either lenders or investors. We want to know why you need a business plan and how do you even create one of those. We'll talk about what the leverage ratios are and how you use them to assess your business, how to measure and quantify the business profitability and ability to repay. How do these leverage ratios vary between business types? So we'll get into the detail later, but these leverage ratios will be different for different businesses, different industry types. And we'll look at what the reasons are for that. And want to answer the overall question of how do lenders look at my business? So there's 5 C's of credit. So when a lender or an investor is looking at your business, they're looking for these 5 things. The character of your character. This will be your personal character. This will be the character of the business, the culture that's been cultivated. It indicates your reputation as a borrower. Things that are looked at is your personal and credit reports and your general reputation in the community. Are you somebody who has a reputation for taking responsibility for the debt that you've taken on? And do you do your best to repay those debts? The next C is capacity. This is your ability to repay the loan. So you may have all the character in the world, but you may not actually have the asset base in which to secure that loan. And so they are going to take a look at, how prosperous is your business? How liquid is the business? What are your available reserves? And particularly, what are the expected economic conditions and the marketplace? Capital is the next one. So this is your commitment to the business. How much money are you putting into the business? And it's not always money. There can be intellectual capital. That, of course, is a riskier space for the banks to be in. So this is the banks are looking at, okay, if you have, $50,000 of your own money, are you willing to put it in? The 4th C is collateral. So this is your ability to secure the loan. This is the assets, the property and equipment and inventory of the business. It includes your accounts receivable and your inventory. So anything that the company has invested in. So an example is a business that's looking at acquiring a building so that they don't have to lease anymore. Now that building acts as collateral for the loan. And if the business doesn't succeed, the bank has the ability to have that asset and resell it to make good on the loan. So if you've got collateral, they will be able to give you a bit more money. The conditions is our 5th C, and that's the terms of the loan. So and this will be your terms of the loan or the terms that the investor has put in place. This is the interest rates, the financing fees, the adjustment periods. It could be, in the case of an investor, if repayment isn't made in a certain period of time, that they take on more equity, they take on more control and ownership of the business to run it themselves. And yeah, so the 5 C's: character, capacity, capital, and collateral and conditions. These are long-standing 5 C's of credit. I took university a long time ago, and these have been around for quite some time. So why would you need any additional financing and capital? First, you might be in a sales growth. Sales growth requires more people, it requires more equipment, and the money doesn't usually come in first. You have to invest in these people and assets before the sales are made. So often there's interim financing required in growth phases. Some other reasons are that you're stocking up on inventory. Again, stocking up on inventory indicates that you have a future projection of increased sales. I can think back to COVID. One of the business owners I was working with, in their mind, they thought they had an inventory problem because their staff had been overbuying inventory. And in their mind, overbuying because their inventory turnover ratio had gone to a year when it used to be 6 months, meaning that they had 1 year of sales on hand instead of their usual 6 months. And turned out that in COVID, their inventory was sold in a very short period of time. As we all know, that certain things got sold a lot more. We have facilities and staff expansion. So again, when we're doing a facilities expansion, a staff expansion, these are all to do with growth of a business, the forward-looking. Now, and then the one that doesn't have to do with growth is that sometimes we have a mismatch in revenue and expenses. In my personal experience, we had a golf course. The golf course has 6 months of operations and 6 months when it's not operating, and they need some financing over that winter period, because if the summer didn't do quite as well as they hoped, or quite as well as a prior year and how they budgeted, they will need some financing to make it through the winter months and just sort of keep everything, their base staff and things like that operating so that they can open the next spring. There's all kinds of seasonal businesses like that. I see several here that are working with farming operations. Again, you've got, you do a whole bunch of work and then you get paid at the end. All of these things, you would have these times in the business where you would either have to rely on cash that you had earned in prior years, or that you would have a financier that would give you some of that money to float you through that period of time. I'll just point out that the bottom comment here is that when you're looking for financing, you need to convince the investor that the investment will result in profitability and that they will have a return of their money, their original capital, and the interest on top of that. So we want to now look at the typical sources of financing capital. This is actually done as an exercise, and in this environment, I'm not able to do it completely like it was planned, but we will, I'll just share this screen. So these are the 5 typical sources of financing and capital. And the question is, rank them from the easiest source of financing to the toughest. And I'm just going to give you the answers. The first one is family and friends. Family and friends are typically the next source of funds following an initial investment of an owner of a business. So, I start a business and Uncle Joe has lots and lots of money, and I know he likes me and he knows me really well and he wants me to succeed, and I can go and ask him for a loan. These are investments can be made as a handshake. In my world, I prefer to have them written out just like it was a third-party loan, so that there's a formality and a clear understanding between the parties, and that it is done like a business right from the start. Because I think all of us, even in small business, want to be running our businesses as world-class as possible. And so when we start with that perspective, then we can go and get the financing that way. So it is true that it's often just done on a handshake. That's okay when maybe you're 14 years old and you're just doing your first lemonade stand and getting an idea for how business works. But when it comes to more formal business operations, it is best to just take a look at what market type of investments would look like. We will keep the documentation to a minimum. It's not a 20-page mortgage document, but still have something in writing, even if it's a one-page promissory note. So the advantage of this family and friends is that it's usually a lot easier to get. The downside is that lifetime bad family relations can result if somebody doesn't repay. And again, this is why clear documentation right up front, even though their friend or family, can help make it clear as to, this is what I expect. I really do want my money back. And maybe at times it's like, oh yeah, I know you've got a great idea and we're not sure how it's going to go. I would like my money back, but if it fails, I guess it's okay. We want clarity in those types of discussions right up front so that we don't sour a family relationship for life. From a tax perspective on family loans, I'll mention this, that you do have the possibility of getting an allowable business investment loss. It's a special tax treatment for small business corporations that if it is documented well, I have to preface that. If you've had a lawyer write that document up, that there is an interest component, so there's an expectation of income to the lender, then they could be able to write that loan off against their income on their personal tax return. Or if it was lended from that lender's corporation, their corporation could be able to write it off, but it has to be done at market rate terms. Now, the second source of financing that's the next easiest to get is unsecured borrowing, including credit cards. So this is typical in business. You go in, and it's usually quite easy to get these. I know when I started my own business, I could just go to the bank and I said, I'm starting this up, and they gave me $25,000 worth of credit card and line of credit capacity right from the start. It's really quite easy to obtain. I will say the interest rates are expensive. So in current market conditions, the line of credit is around 8 to 9%. And the credit card is, of course, the usual 22, 24%. So it is really important to have those amounts paid off on a monthly basis if you do dip into them. These are relatively easy because it is based on the individual's borrowing capacity. So if you have a very good personal credit rating, you've paid off all your debts along the way, you've got maybe a mortgage that you've had over your lifetime that you've been making regular payments on, and you don't have any defaults, or have, maybe a default that happened 10 years ago, something like that. And I don't mean a default in a whole mortgage, but missed a payment one time and had to do a catch-up payment the next month, that type of thing. There's a few downsides to this. If you fail in your business, this will affect your personal credit rating as well. So if you had a really good personal credit rating, you start a business that's kind of flopped, and you weren't able to pay that money back, and you didn't have enough money personally to advance the business to pay that debt off, and it will affect your personal credit rating.
One of the things I'll do as well is I'll place in the chat the links to Equifax and TransUnion, because those are the two credit reporting agencies. I actually refer, if you're in business, one of the things you might want to do, or even for your own personal interest, is check your credit report every 3 months. There could be stuff on there that is totally not accountable to you. It could be stuff that shouldn't be on there that impacts your credit score, your beacon scores. And these are vital pieces of information that are going to determine often your interest rates, how much money you can get, that sort of thing. And if you're new in business, like most of the Business Link clients are, you want to start to access credit and capital early while you still have great credit and maybe a job and all of those things. You want to start to shore yourself up with some of that stuff. So I'm going to put TransUnion and Equifax, and many of you can actually attach that to your credit card. For example, my CIBC personal credit card, I pay a small fee every month and I can just access my credit report any time of day or night. So I'll put those in there as well.
Thanks for jumping in, Linda. That's very useful information. So I appreciate that. Now I'm going to move on to the next easiest form, and that is banks and credit unions. So now now we're going away from these unsecured. I just want to be clear that the unsecured, they haven't put any kind of lien on anything. They haven't put a lien on any of your property to say that if you don't repay, we're going to repossess this. It's just simply a loan that they're hoping that you repay. Now, when we get into the bank financing realm, we might now have secured debt in there, things that were a loan for a piece of equipment, a loan for a building, that type of thing. The banks and the credit unions will require some extensive documentation of your ability as owners of the business. You're going to need to tell them your history in the business, what you're intending to build with the business, and how it is the business will repay the loan. And then this is where you need business plans, you need your projections, your financial projections, and you need to indicate all of the assumptions that you're making in those projections. The fourth one is government programs. So the government offers lots of financing. These days, there's all kinds of grants. There's the new digital grant, along with the digital loan to get your business all digital. They provide some extra supports. This has even a higher level of documentation for your business plan and exactly what you think you're going to do with the business. The government program will often have lower interest rates than the banks because they are offering this as part of their business, business growth, the business development in the country. Part of the reason why we have the digitization grant is because the government has realized that Canada businesses are far behind on the digital world, that many other countries are far more digital than we are, and that we need to upgrade. So, other programs and incentives, they fall into the higher risky businesses that we all need. Farming's risky because it depends on weather, but we need food. We could have all the money in the world, but we would not be able to buy food if food didn't grow. So the government offers all of these things, but they still require you to have a clear business plan. They want to know that they're giving this money for a valid business, a sustainable business, something that will invest the way that it's intended to and make that money back to the best of its ability.
So for those in the session right now, I'm also going to insert into the chat links. Business Link here in Alberta delivers 2 of the digital programs from the Government of Canada. We deliver CDAP, and we deliver what's called the Digital Economy Program, which provides digital support and grants and services and things like that. So I'll put those links in the chat, along with a link to the Government of Canada section of their website, which allows you to sort of self-assess who you are, the type of business you are in, that sort of thing, and locate what programs and grants and loans and lending programs are available to you across the country. So I'll put those links in for everyone as well.
Excellent. Thank you so much, Linda. Now, the fifth one is the venture capital firms. And this is used a lot in real estate development, and it has to be, because real estate is one of these very speculative areas. And so these are people who, they have a lot of financing, they have a lot of capital. These are, they're often run by people who have just a lot of wealth. And because they have a lot of wealth, they have the ability to help new businesses get going. So those people with new ideas get going. Riskier area. That's why it's suitable to the people who have a lot of wealth, because if they lose that wealth in the process, then they're not personally homeless, let's say. They're not personally affected as many of the rest of us would be. And but they still require that business plan. They do want to get a return. It's not that they're out there in a charity manner. They really do want to see businesses thrive. And there's all kinds of different things in this. There's high interest loans where they want 14% return on it. They could be partnerships where they're going to partner with you and help share with you their knowledge of the business and financing world in exchange for a higher return, because basically they're acting like a consultant to you. Okay, so now we'll just move on to the lenders and investors. So these are the different, we've talked about these. I want to express that we have different categories. So even though there's government and there's banks and there's these venture capital firms, they can either lend to you or invest in your business. So when they are in the role of a lender, they will give you money at very certain terms and conditions. They're not going to be calling you, may not even talk to you. I in my own business, I ran a business for 10 years. Prior to these two businesses that I have now, I got the money, I repaid it, and there was basically no contact at all. I think they asked me for financial statements one year because I did a leasehold improvement, and it was a very large investment in relation to my business income. So they're just going to require some periodic reports and meetings. Investors, on the other hand, they become your partner. And I liken this to Shark Tank, if any of you have ever watched it. They're looking at these business opportunities as this investor, where they're going to partner with you, help you with social media, help you grow your business acumen, because you have a really good idea, you're really good at your business, but they also see that there's some lack of skill or some of the tools at hand, and so they're willing to walk along with you. They can be intrusive. They can be telling you what to do, so that and that may not be congruent with your own goals. So you have to vet that. And it can trigger some really painful provisions if performance targets don't get hit. Now, let's talk a little bit about the character of the borrower. What are the more detailed things that they look at about character? Here they are. They're going to look at your credit score, both your business. So if you've got prior business history, they're going to take a look at the credit score of that business. They're going to look at your personal credit scores. They're going to analyze your experience in the business. How long have you been doing this? And not just experience, they're also going to look at your current level of business acumen and up-to-date knowledge. They're going to look at your experience with the lending institution. So, if you're going to TD Bank and you've banked with TD for a long, long time, they will see your history. The longer your history and the better that history, then they will consider that a higher level of character. They're going to look at your reputation in the community. Do you have some very happy clients out there that had great experiences with you? Do you have some really good business partnerships that you work with? And they're also going to look at your relationship with the lending officer. You know, how good are you? How transparent are you with that lending officer? Are you, willing to give them a call if you're having a little trouble, and willing to address any potential problems by initiating effort on yourself to get them to help you with a particular problem? Hey, look, I suddenly realized, we've been operating for 3 years, and for I'm taking a look at the business, and I found out that we're not going to have quite enough cash to meet our loan payment that's due next week. I can tell you all the reasons why. I can tell you that I'm completely expecting to have money come in the following week. How transparent are those discussions? You need to have that, especially if you've got a high level of debt, and that particularly in riskier times. I'll say too that your experience in business, if you have successfully worked in the business for 10 prior years, that's a real plus. So if you have 10 years of history, good history, they'll evaluate you higher for your next loaning.
We have a question here maybe to answer from Shane, who talks about we're still in the 5 C's, so to speak. Does Equifax TransUnion collect and report information about my business? I actually don't know for sure that answer. I know that my corporation is so old that it has a credit rating and that sort of thing, but do you have any ideas on that, Vanessa?
I guess I just want to get clear on what that question is asking. Do they collect and report information about your business? If you have a loan, I would expect that they get information and have it. If all the payments have been made and you haven't gone into default and there's been no reportable deficiency, they would just say you're this many years in business and there's no reportable deficiencies, is my expectation. I think once you have credit, that's going to be something that gets communicated to Equifax and TransUnion, because I think all of the banks communicate that information. As far as ranking, that would go based on their ranking system. But if there was a default, they would definitely have something on their system, I'm sure.
Yeah, and we do have Josh Buchanan indicating that, yes. So for everyone's clarity, only if you're incorporated. Your corporation is separate from you. If you're a sole proprietor or you're in partnership with someone, that's all tied to your personal credit. So we recognize that if you want to have a separate business sort of credit history, you should be incorporating and establishing your business as its own entity and its own special thing. So be aware of that as well, that until you incorporate, there's nothing that separates your personal credit from your business at that point.
Thank you for that clarification. I was only assuming in my head that it was an incorporated entity, and I will say this too: even if you're an incorporated entity, a lot of times you've also done personal guarantees to get a business up and running, and so anything that happens inside the business will affect your personal credit score as well.
Yeah, and as a business owner, and I've been in business since 1993, it took me years and years and years before the banks actually looked at my corporation and me as separate and were willing to lend separately to my corporation, as opposed to me signing documents saying, here you go, Linda, you can have all this money, but you need to sign this personal guarantee on this particular thing that you're getting. And that happened for many, many years. So it's not like you suddenly incorporate and the banks magically open their doors to your corporation as its own special thing. It takes a long time to establish that. One of the best things you can do actually is establish a really close relationship with your commercial bank account manager. That is your go-to. I cannot say enough about how helpful, and I know we don't say that a lot about bank account managers, but my account managers over the years, being connected with them, they have led me to networking. They've led me to other financing resources. They have talked to me and asked for my financials every year and worked with me to develop plans to build towards that very special day when you can go and get certain access to credit that you can't get early on in your business. So it does take time.
No, I really appreciate all those comments, Linda, because I only talked a little bit about the problems, and I think that's partly because as an accountant, that's often where I get pulled in from clients. Is they maybe don't look to me as their advisor upfront. And I think that proactive nature is what a lot of first-time business owners don't realize, is that going out there and getting information upfront, asking tons of questions upfront, not making, you make some assumptions and you think you have your plan out there, but really good to go for lunch with your commercial lender, have a chat about, what resources they have out there. I like that. Yeah, for sure. We were talking here on character of the borrower. This is also just good tips for you to go out there and get more information to help your business grow. Okay, so now we want to measure capacity. So when we go back to those 4 C's, that's a couple slides back, but one of them is capacity. How do you even know what you have as capacity? How do we measure that? That's what these are to answer. So we want to take a look at the liquidity ratios and the leverage ratios. And anyone who's interested in a bit more detail, like quite a bit more detail on that, they would go back to the balance sheet session that I did last week. The liquidity ratios are current, quick, and the one-time horizon. The next slides will talk in detail about those. The leverage ratios are debt to equity, your interest coverage ratios, and the fixed payment coverage ratio. The liquidity ratio, the current ratio is your current assets divided by current liabilities. And this answers the question, does the business have adequate liquidity? Has it got enough cash on hand to pay debts that are due right now? The higher the number indicates less liquidity risk. Okay, so the higher the number. So that means that if your current assets are 200,000 and your current liabilities is 100,000, you have a 2-to-1 ratio. Well, now, yeah, clearly we've got twice as many assets to pay off our current liabilities as what we have in liabilities. So yeah, we're good. A ratio less than 1 is clearly a liquidity problem. So current assets at 50,000 and 200,000 in debt, that's a problem because that debt is due within a year. You only got 50,000 in assets that you can liquidate in the next year. So you've got $150,000 deficit. That's clearly a problem. You need to talk to your lender and ask them what they want, because your lender will probably have this in some kind of an agreement that they have in order to give the money to you. Need to be certain that you're staying on side with that. And that goes back to my transparency piece, is that if you're seeing, you need to be on top of it proactively looking forward. And if you see that there's going to be a potential problem, find out if you can solve it entirely on your own before the due date. And if you can't, that's when you phone the bank and say, look, I am looking at my numbers. I am going to have this problem. I'm going to be a week late. Just letting you know ahead of time so that there's no big surprise. And that's what I mean by that transparency when there's a bit of a problem. The next one is this quick ratio. We have current assets minus inventory, and you divide it by liabilities. So why would we take inventory out of the equation? Well, it has to do with how likely are we to sell that inventory? We want to be, especially taking out inventory that might be obsolete. Okay, so does the business have adequate inventory? Adequate liquidity. Remembering that inventory happens because we have sales. So in my earlier example where we had this business that had thought they had overbought inventory, it was a happy surprise when COVID happened and all their inventory went flying off the shelves. They just happened to be in a lucky situation. But before that situation happened, it didn't look good because the liquidity, their inventory was making up a very large part of their current assets. A ratio of less than 1 is clearly a liquidity problem because again, if we had, let's say, 200,000 in assets, and let me say that again. You have $100,000 in assets and $200,000 in liabilities, but the inventory is 75,000 of those assets. So 100,000, we take out the inventory, we got 25,000 in assets to resolve current liabilities of 200,000. That's going to be a problem. We're down to 10%. We're always using a one-time or a 1-year horizon, but we can also be looking at this on a monthly basis. There's some ways to make that a monthly number as well, to make sure that you're dealing with your monthly obligations as you go along. Now, debt to equity is our next leverage ratio. This is our total liabilities divided by owner's equity. To be clear, owner's equity is the sum of your retained earnings, the earnings that have been retained in the business since the beginning of time, plus the share capital that if you're an incorporated entity, your share capital. The share capital is whatever you paid for your original shares. With most small businesses, that's maybe $1 or $100, pretty small number. So we're basically looking at the earnings that have been retained in the business. Debt to equity is a measure of how leveraged the business is, and capital intensive businesses will have higher ratios. And the reason a capital intensive business can have a higher ratio is because the banks will use the assets that have been acquired with the money as collateral. So if the company has bought a building, if the company has bought property and just some equipment, then the bank could take those assets and use that to settle the debt. And in that case, they will accept a much higher debt to equity ratio. Anybody who's a consulting business, I was reading that some of those are consulting businesses, that you will, if you had to borrow to get your business going, to just have an operating line to pay staff, etc., they'll want a number of 2 or lower. I'll also say that this owner's equity, sometimes the banks will use a shareholder loan amount in that equity, provided that the shareholder loan cannot be repaid, that there's been a restriction on that loan. I have an entity right now that does some real estate financing that shareholder loan kind of factors into this equation.
We have, just to confirm, Karen has a question. Will our inventory be included in our assets? I think you answered that, but just to clarify, is that a yes? Inventory?
Inventory is an asset. And when we look, I'm going to just flop back in the slides. When we look at the current ratio, inventory is typically a current asset. There's a couple business types where inventory is not a current asset. Real estate, for example, it might take a year to build and then by the time it's actually sold, it's 2 years. So that's one special industry. But for retail operations, think of the Walmarts or the corner store or anything like that, inventory has to be a current asset. It is going to be sold in the next year or be become obsolete, right? And so it's definitely an asset. But when it comes to the quick ratio, we remove inventory. And we do that because the inventory is not as liquid as accounts receivable. Accounts receivable, we should be getting the money right away. Other current assets are cash, and maybe some short-term investments, a GIC or something like that. So those other assets are much more liquid to pay off the debt.
Stuff you can move quickly. It sounds almost like dark web, Silk Road. Your liquid assets are the things you can move fast. and so if you've ever watched those car loan commercials on TV where they said good credit, bad credit, no credit, we can lend to you. That's because they know they can seize that vehicle and get their money back. And so they're not lending to you, they're just lending on the value of the asset itself.
And that's the same with I forget the name of it, but there's that lender that lends money against your home, and they advertise on the radio all the time. And
Alpine credits, that's it.
Alpine credits, and it's because they know that they can just repo your home, or they can, force you to sell it at some point in time. It isn't as immediate as that, so don't get all scared and scared by that. But they're using the value of your home to cover that.
And for those of you in rural areas, community futures, if you're not familiar with community futures in your area, community futures is really, they have lending programs as well, and community futures really focuses on lending based on your assets. So there's a lot of asset lending through community future, equipment, tractors, things like that are things that are asset based. It's good to walk into your community futures office if you haven't done that in years, and just sort of find out, what the heck are they doing these days, and what are their lending programs about as well, because that's what they're there for in those communities as well.
Mm-hmm, mm-hmm. And those are always of interest to people who have assets and want to actually start a business and do something with those assets, for sure. And we get into leverage ratios. The interest coverage ratio, the fourth of the leverage ratios. So it is calculated as your operating profit divided by interest payments. Now, this operating profit, there are a few different definitions for it. I'll say that. It can be earnings before interest and taxes is typical. It can be earnings before interest, taxes, and depreciation. And the reason they're dividing that by the interest payments is they're trying to determine how much extra profit you have after paying your interest. You want to be sure that you can at least pay the interest, but they also know that you have to be doing things like reinvesting in your business all the time. So you need to have that extra, the piece that's above and beyond just the interest component. If you've signed a loan with the bank, they'll usually want a ratio of 2 or higher. They prefer that. And you'll have to just ask your lender what they expect. If they don't put it right in the loan agreement, they should, especially if you're going through a formal bank loan process. But if you have any doubt, you make sure you ask, because these are the numbers that they're the targets that they're going to be looking at, especially if you have to report monthly or annually. Now, we also have a fixed payment coverage. This is taking a look at, it's answering the question, can the business afford its fixed payments? Okay, so fixed payments are anything that happens on a monthly basis. Leases and real estate leases. It can include your any regular payments that you have. In today's world, it's also your subscription payments for internet or any kind of software programs that you have to use to run your business. It is calculated as your operating profit plus your asset lease payments divided by your interest plus principal plus your asset lease payment. And we, generally speaking, we want a ratio of 2 or better is what's preferred by your lenders. And in our example, I'm just going to go through this example to try and make it clear. We have $7,167 of operating profit. We add in our lease payments. And then we divide that by our loan. And that's our loan payment. I'm going to say that this is maybe an annual amount. So this is taking a look at your annual operating profit divided by your annual loan principal and interest payment and add in the lease payment. And this calculates to be a 2.6 coverage ratio. So leverage ratios can be different in different industries. I mentioned that at the beginning. The more leveraged the business, the more risk it has taken on. Okay, so the higher the amount of debt in relation to assets and in relation to equity, everything's relative. We can have businesses that have $1 million of debt and they're perfectly fine. And we can have businesses that have $100,000 in debt and be having a real problem in trying to pay that. So it's all relative to all of the other numbers that are in the business. Some companies can have a maximum acceptable debt to equity ratio of 2. I mentioned that earlier. 2 is a very common number. The average debt to equity actual ratio is 1.5. Capital industries will have debt equity that's higher. Again, that's because there's assets that collateralize the loan. Another thing to know is that established businesses, those that have been around 10 years or more, they typically have the ability to have higher debt to equity ratios because the lenders are more willing to lend to them. They've established character, they've established their capacity, they've probably got some really good business relationships going. Now let's talk about capital. Your lender or investor wants to know how much of your money is in the business. So when we talked equity ratio earlier, we talked capital stock plus retained earnings. So the earnings that have been retained in the business plus all of the amount you paid for shares divided by your total assets. Another component that can be added in there is a long-term shareholder loan. And that means that if your corporation, you as the shareholder, has not bought shares for $100,000, instead lent the company $100,000. And that $100,000, you are not expecting repayment. There might be a restriction in the loan agreement that says you cannot repay that money until certain conditions are met in the business, such as 90% of the loan is paid off, things like that. That will also count in this equity ratio for most banks. Now, collateral is the property that will be seized if loan payments are not made. A lien, so there'll actually be a registered lien on the property so that title cannot be transferred. This happens on vehicles where it's registered with the registry. It happens with a property. Anybody who has a mortgage on their home know that there's a lien placed by the bank so that you can't sell your home until you've repaid that debt. Anything that is collateralized will reduce the risk to the bank of extending credit, and it limits the loan losses for the lender. Loan-to-loan ratios vary. This slide says typically 65%, but I will say that when it comes to commercial real estate, they'll usually accept 75%. So I just want to be clear how that kind of works is that they will lend up to 75%. So it means you have to have a 25% down payment. You have to have 25% of the purchase price upfront to put towards it. And what they're essentially saying in that is, well, we know if you don't make good on the payments, we will definitely be able to sell the property for at least the loan value. And they're giving a 25% or sorry, yeah, a 25% buffer between the purchase price today and what that sale price could be whenever, if there was a default, plus all of the costs of administering that, remembering that real estate agent commissions will be, in the neighborhood of about 3.5%, 4% of the sales price. Know this, the lenders do not want your collateral. They don't want to have your building. They don't want to have the equipment. They don't want to repossess anything. It's just that they are doing risk management in case something fails. They really just want the business to succeed. And going back to Linda's comment, this is why that relationship with the lender is really important, because all lenders want to see their people succeed. All of the businesses that they've invested money in, essentially, they've invested mortgages in, they want to see them succeed. And so keeping that ongoing communication and getting all the information you can, asking all kinds of questions on supports. Their business networks are very large. They generally, have a network of 400 or 500 people all the time. So leveraging that is so huge. There'll be all kinds of loan conditions that you need to make sure you understand what you're committing to. These are expectations that the lender is putting on you and your business. They're going to tell you what those interest rates are. If it's based on prime, you have to keep on top of where the prime is. So if it's 1 or 2 percentage points above prime, you have to constantly watching what those bank rates are so that you can anticipate increases or decreases. They're going to have some fees to negotiate this. And sometimes those fees are fairly high. And it's partly because they might be providing you a bit of consultation in that, and they're making sure that they can cover their people time cost in order to do all of the education that you might need as a business owner. They'll have a time length on it. If it's an operating line, it's usually indefinite. If it's a mortgage, they'll say you have a 5-year term and we will renew those terms in 5 years, but we're going to do an amortization schedule of 25 years. So there's they will clearly specify these things. They will tell you how much your line of credit can be. I'll add in a tip here that if you do have a line of credit, you typically want to stay at 75% or lower of that maximum. So if you have a $100,000 line of credit, you would not want to exceed the $75,000 mark for very long, generally 6 months or less. There may be times when you can pay interest only. You can negotiate this. If there's been a change in the business and you are seeing a way out of it in the next 6 to 12 months, you kind of get a handle on when you think you can get out of that. You can go to the bank and say, look, COVID is a good example. Look, we've just had, a big hit on due to unforeseen circumstances. We're expecting this to be resolved in this amount of time. Can I go to interest-only payments for that? And you know that whatever terms you sign up for, you can go back and renegotiate them if things change, but you have to be really clear on that. You do not want to be going back and renegotiating all the time, but don't see it always as a fixed thing. Ask questions. You may not always ask directly of the lender. You may go out and ask other colleagues in the business about, what kinds of things they might have done in certain circumstances. And then that gives you some kind of basis to do some renegotiation with them. The loan will also determine any triggers where you have to repay or if you're going to be in default on that loan. And there may be triggers to change interest rates. In the example of the 5-year term, every 5 years you renew whether you're going to be fixed or variable, and then you're locking yourself into a different rate. I'm seeing that we have about a minute left, so I'm going to go through all of this quite quickly. From an investor side of things, investors are becoming a partner in your business. So they expect to have an equity position in your firm. They're going to monitor and involve your firm. They are probably going to want monthly statements. They're going to have certain criteria on what those statements look like, what kinds of things you're going to report on. Generally want to take a look at your strategy, your mission, your direction, and be looking at your key performance indicators. Key KPIs are going to be performance measures that are the underlying thing, not just your finances, because finances are an outcome of a business, the underlying business performance. The investor may want more protection. They might want life insurance on the owner because they know that the owner is key to the business. And if anything happens to that owner, they want some life insurance and maybe even some critical illness insurance, and also some insurance to find another person to come in and take over in the case that the main business owner is not able to do their work. And they may just force a payout, or they may force the business owner out to take over the business. There can be all kinds of different clauses in the agreement. Always have a lawyer go through any agreement that you sign with an investor. And the lawyer is there not to give you the agreement. The lawyer is there to educate you on all of the things that you can negotiate in that agreement. They have tons of experience. They know the pitfalls. They know the things that you need to talk about upfront that so many people don't want to talk about upfront because they're, I would say usually just because they don't know. You do need a business plan, and I really wish I had a bit more time because this is really where I needed to spend a bit more time. I think there are all kinds. You need a business plan to get money. It has to be a 2 to 5 year forecast. It has to include a description of all the things that you are tending to focus on. Probably a definition of some of the things that you won't get into because you want to focus your business in a certain way. And it will have really good understanding of all the financial pieces that go into that and all the underlying numbers. How many units and widgets do we need to sell in order to cover all our fixed costs, etc. Bankers want to see you as a profitable company, a profitable customer, a profitable partner. They will also see you as a potential way to lose the capital that they've invested in you. And they will see you as a potential risk that they need to research. So they really want number one, but they're going to do all of their due diligence on 2 and 3. So you have been given a bunch of resources, a glossary of terms, the implementation checklist. There's great resources on the Business Development Bank of Canada website. So do check out these links. And that's all I have. I had one question in the Q&A that I have not answered, and that is, yes, I do fractional CFO and fractional controllership for small businesses that don't need a full-time person. And other than that, I hope you enjoyed the presentation. If there's any other questions, do put them in. I see one from Karen, actually.
Okay.
Your inventory can be considered collateral, and it'll depend on the type of inventory that it is and how perishable it is. So inventory in a grocery store, not going to be collateral. Vehicle inventory at a car dealership, absolutely collateral.
So a couple of things to remind everybody as you're waiting to end here, if you want to hang on a little bit. I have put the link to all the handouts, including a copy of this PowerPoint presentation, in the chat look in chat at the latest link and a copy of that is sent. That link is good for 30 days. So grab your link and your handouts and everything else there. Another note, we will be posting a recording of this webinar to our website. If you go to businesslink.ca and you go under resources to recorded webinars, you should see this webinar probably arrive on our site in the next 2 to 3 business days. So watch for that. All the previous ones from CPA Canada are currently up there. So go take a peek at those, especially the ones where we've talked about financials and that sort of stuff. Vanessa's given some really amazing presentations on all the ins and outs of that, which your bank is going to sift through and dig through as they decide whether they want to lend to you or not. We do have a question. How many months should I wait to build my credit payments and present my bank business plan to a bank for a loan to start a business? Start immediately on everything. Start it now, sooner rather than later. I mentioned earlier in the presentation, if you are starting a business and you're still working, you've still got career income coming in or work income coming in, that's the time to work with your bank and say, look at how fabulous I am and how great I am to lend to, and look at my wonderful credit. And can we make sure I've got a line of credit and a spare credit card on hand and a few other things on hand that you're going to need as you start a business? Because if you're leaving your job and you're leaving those things to start a business, all of a sudden your ability to access capital diminishes pretty quickly. You're not sort of in the box that banks like to see you in. So build that before you start. If you're in sort of 0 to 1 in year 1 of your business, and you have the ability to build that relationship with your banker, do that. That's very important to do. Check your Equifax personal credit scores, because that's how you're going to be lent to right at the beginning from any traditional lenders, including programs that you're accessing. If you're accessing Alberta Women Entrepreneurs or anyone else, they're looking at that stuff too. I did put a link into the chat earlier. I don't know if people grabbed it or not, but it is the Government of Canada page, and I'm going to put it in now. Services and information on business grants and financing. And what you can do there is you can self-identify. Am I a female entrepreneur, an Indigenous entrepreneur, an immigrant entrepreneur? Am I new? Am I in Alberta? What place in the world am I in? And if you start to fill in the blanks and fill in those answers, am I a youth entrepreneur? That website will pull up all the available programs, grants, loans, digital economy programs, tax incentive programs that are available across Canada. That's your go-to place. So please check that out. Let's see.
Linda, there's a question that's popped up that I'm happy to answer, and that's from Amy. She's asked, how does somebody get a loan without having 3 years of financials? So, and to build on what you said, Linda, earlier, from my own experience, I was working when I decided to start my own firm. I went to talk to the bank about 9 months, 10 months before I was going to do that. And when I went in, they extended to me a line of credit and everything based on my work income at that point. And it gave me the ability to have an incredible amount of financing before I went out and did my business. I had my business plan that was a 5-year projection. Went through that with her as well and was able to do that. I didn't have any history. I was just going out in faith that I knew what I was doing, and they were able to take a look at that and use that as support. So it really goes to the credibility of the assumptions that you're making in those projections. You do not need to have the business history. If you have a really good idea and you have experience in the area that you are going into, it doesn't have to be experience necessarily in the particular thing you're selling, but it has to be some business experience that is helpful. Or alternatively, it could be something that you have a lot of experience in doing and don't have the business experience, but you are clearly looking for the support. And these things can all be really helpful.
Definitely. I have the same, it's going to be hit and miss. If someone says no to you, if you're in front of a lender or you're in front of people who you think will be able to offer you help and assistance, don't take no as the only and first answer from them as well. So a bit of advice as an entrepreneur is, if someone's saying no to you, and Amy, it sounds like you've received that from your bank, say, okay, what can I do in lieu of having 3 years of financial statements? What are my other options? Can you talk to me about those things? And it's not a problem to shop around. You can talk to other banks, but if you know why they're saying no to you, then you can assess how to change your ask moving forward. You could say, okay, well, what if I tried this? Or what do you suggest I try as an alternative option? Don't just let them say no and shoo you out the door. Like, really grill them on what you need to get done, because it's your business and your livelihood and your way of supporting yourself. Don't just feel like you have to take no and that's the end of it all. Hey, phew, we've gone 10 minutes over. Thanks for staying a little longer, Vanessa. I appreciate your time. Thank you, everyone, for staying a little bit longer. For our marketing team behind the scenes, if you want to end the recording, that's fabulous. We can end it now, and this will get posted in the next few business days. Thanks, everyone, for joining today. Really appreciate it.
And thank you.